From the morning reading, the spider nears high on light volume while volatility drops. 6 of 9 sectors moved higher on Friday. XLE, XLU, and XLP were the strongest sectors, while XLB was the weakest sector. Oil futures rose 28 cents to close at 41.38. Breadth strengthened compared to the prior session as advancers led 1871 to 1117 on the New York Stock Exchange, and decliners led 1333 to 1262 on the NASDAQ. The spider continued its 12-day sideways trend while the Qs closed at a new high. On the S&P 500 snapshot, we have a weak GDP, but no worries. The potential mover and shaker on Friday was a surprisingly weak advanced estimate of GDP for Q2, not to mention the downward revisions to the 2 previous quarters. But no worries for the market. The S&P 500 hit its 0.30% intraday low about 30 minutes into the trade and then bounced to its 0.32% intraday high during the lunch hour. A record intraday high for that matter. A bit of zigzagging in the afternoon cut the closing gain in half to 0.16%, just a tad shy of a record close. The bond market took a somewhat different view. The yield on the 10-year dropped 6 basis points to close at 1.46%. That's 9 basis points off its all-time closing low and 11 basis points below its close on July 22nd when the S&P 500 set its latest record close. In other news, falling dollar boosts commodities. Emerging markets reach a 12-month high. The EAFE shares look stronger for the developing markets. And then the QQQs touches record high as Alphabet surges. Breadth has been strong with solid participation across all market sectors and a large percentage of stocks. The sharp upturn in the advanced decline line continues to lead to a higher market, a sign of broad-based strength. And then finally, with continued assistance from accommodative Federal Reserve, this is the second longest bull market in over 85 years, and twice during the duration or lifespan of a median bull market during this period. However, at the same time, we fear this may have become one of the most interest rate sensitive bull markets in Wall Street history. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:51 a.m. Mountain Time, and I'm recording this in preparation for the market day of August the 1st, 2016. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. Okay, let's go ahead and dive into the morning report. At the time of this cut, action across all 4 of the U.S. broad-based indices was rather muted, but positive. The S&P futures were just up over scratch. The Russell futures were up about 0.25%, and NASDAQ and Dow futures were up just above scratch. Crude oil was down 1.37% for the biggest mover of the ones that we follow. And then Euro was down just below scratch, bonds down about 0.5%, and gold down just below scratch. In overseas action, China was down about 0.87%, Hong Kong up over 1%, Japan up a little over 0.33%, Germany down just below scratch, and the United Kingdom down about 0.33%. In terms of macroeconomic reports for today in the United States, of note, you have ISM manufacturing PMI. And that looks to be about it. In terms of looking forward to tomorrow, we have core price index, personal spending, so a little bit of inflation-related reporting. current volatility conditions, you heard one of the morning authors refer to this dropping. And indeed, you look at the IV percentiles, not only are they single digits, they're all 5 or less. So they literally cannot get much lower. Obviously you can set a lower and lower 52-week low volatility, but in terms of percentile, you're as low as you're going to get in terms of all 4 of these indices. I mean, there's no statistical difference between where they are right now and getting any lower to speak of. You see the short-term VIX 11.79, the skew just barely in caution area. There have been 0 standard deviation moves in the last 2 trading weeks on the S&P and the Dow. That continues. Only 1 session in the Russell. So very, very, very low volatility that has been moving through the market of late. We are clearly in the throes of the summer doldrums. In terms of our current charts, let's go ahead and go to the S&P futures. You see in the Globex activity, we did tickle to a new all-time high, 2177 3/4, though we have backed off of that a bit since. In terms of the overall action, we are attempting perhaps to tickle outside of this sideways consolidation pattern that we've had for the last 2 weeks. We'll see if when the cash participants come in, if they're able to reverse this overnight weakness since that overnight high was tickled and start to really form something. Right now you just have on weak volume on a Sunday night set of trading, I tickled to a new high and not a lot of confidence being put in that as of yet. In terms of the Dow tickled also its diagonal resistance in the overnight, but did not break through, and certainly has backed off from there since then. So no signs yet that we're going to have anything that's going to push us to new highs with today's session, but obviously when all the market participants come in, we could see something different. NASDAQ also tickled an all-time high in the overnight and has backed off as well. Now NASDAQ in the short to intermediate term pattern has been much, much stronger. So while the others have gone into a consolidation pattern in the last 2 weeks, NASDAQ has not. It's been powered by a number of large earnings reports, Apple, Alphabet, with your several large companies there. So let's also see the Russell's been trying to tickle up through the top of that consolidation pattern as well. But nobody's clearly made a breakaway yet. They've just kind of pressed and probed, but nobody's really cleared the breakaway areas. In terms of, let's take a look at bonds. Bonds reversed much of Friday's action and certainly right now have a bearish engulfing on top of that candle. That would seem to say risk on. And then gold has also backed off a little bit, but nowhere near as much as the bonds have. And then crude oil continues to kind of show really substantial weakness, and after it's broken down from its intermediate term pattern, and then also a cloud breakout to the bearish side, has been pretty much falling straight away. Let's see here. Let's go to the VIX. VIX, just kind of in this low consolidation area. No clear breakouts one way or another. If I were to make a guess right now, I would say today's probably going to be a relatively small inside day. But things can change. We don't seem to have the macroeconomic reports today to kind of push it one way or another in any significant way. But the price action seems to have went up to the various areas of resistance on the equities and then backed off. So it doesn't seem to indicate that we're likely to have a significant breakout today. We'll see. Okay, let's go ahead and go to the daily report. And we do have a couple changes here, especially here at the top. Intermediate term phase opinion, I've turned this to market phase 3, which is the expectation of flags, bull flags at this point. So this is another perhaps more mature area of the intermediate term phase opinion, where we're expecting a series of bull flags in a bull trending market. So that's the expectation until proven otherwise. Obviously, when you look at the relationship of the key moving averages in the market and so forth, everything is nicely stacked in a bull trend mode. In terms of the 3 market timing signals, no changes on this since last week. Our IBD, our first one, comes to us with a confirmed uptrend. The second one, the GMI index, perfect 6 out of 6. Buy signal has been in place for now a month. And the third one, the stock charts decision point scoreboard, no changes there either. Universally green across the short to intermediate term across all the indices. Only this long-term confused signal is holding us back from having something and a stronger signal. Position sizing opinions, both models coming in at 100%, no changes there. Intermediate term phase opinions, I should say that right. Intermediate term market posture on all 4 indices continue to be exceptionally strong. And indeed, they're all up over 90, anything over an 80, and you're going to continue to have this severely strong bull signal. And this is also supported by a bullish sentiment line. The strength of the trend, very, very strong. You see this, it is up over 80 and frankly, heading towards 100, it would seem. So very, very strong. I guess it's currently at a 98.1. Very, very strong signal there. Hedge warning status remains a level 0+, normal with some cautionary aspects. In terms of the 3 strategy opinions, no changes from last week. We're still in this strong bull phase. We'd like to see this develop into a true bull trend. That really is the only thing that is holding us back from getting more aggressive with our initiation of some of the other strategies, particularly intermediate term bull swing strategies using highly leveraged positions. We would probably start to unravel a lot more of those if we should start to see this roll into a bull trending market where we make a series of higher highs and higher lows. In terms of the more conservative strategies, option incomes, covered calls, put selling, these are all pretty much rolling along at this point, and just a matter of picking out your individual conditions. 1 to 2 ratios of in the money, out of the money, so fairly aggressive and bullish there on the covered calls. Also in the low beta to high beta, the same ratio as last week, that 1 to 2 ratio. In terms of areas of specific warning, we still have those 2 low-grade warnings still present in the volatility basket. The volatility ratio warning is in the over extended area and is waiting for a firing signal, but that firing signal has not yet come yet. Skew remains just barely elevated over its warning threshold of 125. In terms of the trend-based signals, they're all very bullish, and indeed we continue to see new highs on the New York Stock Exchange coming in up over 300. Very strong bull signal there. And then the key intermarket risk aversion indicators, this is one that deteriorated during the course of last week, and we continue to see that develop. We have 2 of the 5 signals as risk off, and a third one in danger of rolling over as well. From a sentiment standpoint, we have scrubbed off a little bit of the extreme greed sentiment, but we're still in that upper quartile. So be aware of that. Looking for reversal patterns. It can stay up here for prolonged periods of time, so look for reversal patterns before you actually act on an extreme sentiment setting. In terms of the sector percent change in the market postures, you see here that transportation, consumer staples, energy, industrials are the weakest relative sectors at this point. But it's kind of a mix. You see here utilities, telecom, you know, some of these more defensive sectors are holding up well, but then you have consumer staples that's not. So it's kind of a mixed picture right now, and I think from that mixed picture is what you get when you get sideways consolidated markets and not clear direction to the market participants, whether it be institutions or retail, as to whether they should be risk on or risk off. And so you kind of get this kind of slop going back and forth and not really much to point us to anything actionable. In terms of the action on Friday, you do see telecom was the best performer, and then utilities and staples came in third and fourth. So on that particular session, you had 3 of the 4 of these defensive sectors coming in at the top. But you see the 1 week, those same areas were actually negative. So it is you know, a pretty good mess when you're in these sideways patterns. In terms of the relative rotation graph, this is really quite strong. We have biotech, we have the Internet Index Fund, we have home construction, the REITs, telecom. So we have positions in telecom, we have positions in the REITs, we have a position with FDN. So glad to see all that. But you've actually got, you know, several of these industry sectors that are really performing well and trending into this upper right quadrant. So you know, this should be something that's on your watch list, to be looking at either these industry groups as ETFs or the strongest of the strong components of those ETFs for potential setups. So kind of keep that in mind. I think that's probably enough for today. We're publishing a little late, so we're going to go ahead and wrap this up. Disclaimers, as always, hit the pause button if you need more time for disclaimers. Also note the hyperlink down here at the bottom for the full set of disclosures. We'll see you back here for the next market preview session from Falcon Global. And in the meantime, manage that risk. And as always, seek to go out there and go learn something. Good trading.